In the world of options trading, there are a million numbers flashing on the screen, but there's one number that really rules them all. It dictates your risk, your potential reward, and your chances of success. And no, it's not the stock price, it's the strike price. And getting a handle on this is absolutely key. So let's start with a simple question. When you're looking at that big grid of options contracts, that options chain, what's the single most important price on there? I'll give you a hint. It's not the current price of the stock, and it's not even the price you pay for the option itself. It is, you guessed it, the strike price. You might also hear it called the exercise price. This is the predetermined, locked-in price for the entire deal. Just think of it like the price tag written into your contract. It's the benchmark that everything else is measured against right up until expiration. It's the deal you agreed to. Now, how this strike price actually works depends completely on whether you're holding a call or a put. So just a super quick refresher here. A call option gives you the right to buy a stock at that strike price. That's what you want if you think the stock is about to take off. A put option gives you the right to sell a stock at the strike price. That's your play if you think the stock's going to fall. But in both scenarios, the strike price is the center of the universe. Okay, so what makes this one number so powerful? Well, it's because its relationship to the stock's current market price is what determines an option's immediate value. And to describe this relationship, traders use a simple but really critical concept called moneyness. And trust me, this is the key to understanding everything. So an option can only be in one of three states at any given moment. And you'll hear these terms all the time: in the money, or ITM, at the money, ATM, and out of the money, OTM. Let's break down what these actually look like in the real world. All right, let's look at a call option first. Remember, with a call, you want the stock to go up. So let's say your strike price is $100. If the stock is currently trading at 105, your option is in the money. This is awesome. It means you have the right to buy something for $100 that's actually worth 105. Now, if the stock is trading right at 100, you're at the money. And if the stock has dropped to 95, well, now your option is out of the money. I mean, why would you use your right to buy at 100 when you could just get it on the open market for 95? Now, let's flip it for a put option, where your goal is to sell high. The logic here is the exact opposite. With that same $100 strike, if the market falls to $95, your put is now in the money. You have the right to sell for $100 something that's only worth 95. Sweet deal. At 100, you're at the money again. And if the stock rallies up to 105, your put is now out of the money because there's no way you'd sell it at 100 when the market is offering you 105. You see how that works? Understanding this is so important because it directly impacts the price of the option itself, what traders call the premium. Moneyness is basically the bridge that connects the strike price to what you'll actually have to pay for that contract. So here's the crucial point. An option that is in the money has something called intrinsic value. All that means is if you were to exercise it right this second, you would have an immediate profit on paper, even before you factor in what you paid for the option. And it just makes sense, right? The more profitable that option is on paper, or as traders say, the deeper in the money it goes, the more intrinsic value it has. And as a result, the more expensive it's going to be to buy. The premium you pay simply reflects that built-in profit. That's the direct link. The further in the money your strike is, the more that option's going to cost you. Now, on the flip side, you have out-of-the-money options. These have zero intrinsic value, nada. They are pure speculation. Their price, their premium, is based entirely on other stuff, like how much time is left before it expires and the odds that the stock might just move enough to become profitable. This makes them way cheaper, but yeah, way riskier too. Okay, so let's get practical. How does all this theory translate into a real-world decision? How does a trader actually pick a strike price out of all the choices? Well, this is where your personal strategy and your view of the market really come into play. If you're buying an option, you've got a choice to make. An aggressive trader, someone looking for a home run, might buy a really cheap out-of-the-money option. They're betting on a huge move for a massive percentage gain. The big risk, of course, is that it's much more likely to expire worthless. But a more conservative trader might pay more for an in-the-money option. The potential return is lower, sure, but it has a much higher probability of being profitable because the stock doesn't have to move nearly as much for them to be right. And what about the folks on the other side of that trade? Well, option sellers often use this same logic to their own advantage. A really common strategy is to sell those cheap, out-of-the-money options, collect that premium up front, and then just bet that the option expires worthless. If it does, they just keep the cash. When you get right down to it, it all comes back to this. Choosing your strike price isn't just about picking a number off a screen. It's a calculated decision. It's a balancing act where you are constantly weighing the cost of that option against the probability of success and what your potential reward could be. So, we've covered a lot of ground here, I know. Let's just boil it all down to the most essential points that you need to walk away with. Okay, here's what you need to remember. First, the strike price is your fixed, locked-in price for the trade. That's the deal. Second, its relationship to the market price is what determines if your option is in, at, or out of the money. Third, that whole moneyness concept directly impacts the option's value and how much you're going to pay for it. And finally, and this is the most important part, the strike you choose isn't just a number. It's a reflection of your own personal strategy and how much risk you're willing to take on. And that leaves us with one last thing to think about. Now that you know the strike price isn't just some random number, but it's actually a tool for managing probability and cost, how does that change the way you think about risk and reward when you look at the market?